When you think about China's coffee market, the first image that probably comes to mind is that familiar green mermaid logo from Starbucks. This Seattle-based brand has dominated the Chinese market for 25 years without facing any real competition, and it's been held up as the textbook example of successful international expansion. But here's the thing. This seemingly unshakable coffee empire is going through an unprecedented crisis right now. Between 2021 and 2024, Starbucks saw its revenue in China drop by $700 million, even while opening 2,200 new stores during that same period. What's even more shocking is that a homegrown Chinese brand called Luckin Coffee, which only started in 2017, now has 18,000 more stores in China than Starbucks does, with over 26,000 locations globally. And the latest developments are even more surprising. This summer of 2025, Starbucks officially kicked off the process to sell stakes in its China business, with a valuation hitting $10 billion and bids coming in from over 20 investors. Meanwhile, Luckin Coffee not only achieved 47% revenue growth in Q2 2025, but also boldly entered the US market by opening its first stores in New York. So what exactly happened here? How did a company that was once on the brink of bankruptcy due to accounting fraud manage to completely disrupt the entire coffee industry in just a few years? Let's go back to 2017, when Starbucks was still the undisputed coffee king in China. As the pioneer that brought coffee culture to this traditionally tea-drinking nation, Starbucks enjoyed what was basically a monopoly position. Starting from its first store in Beijing's China World Trade Center in 1999, it took 18 years to build a complete coffee ecosystem in China. Not just selling coffee, but actually shaping an entirely new lifestyle. Back then, Starbucks leadership was incredibly confident about the Chinese market. Former CEO Howard Schultz even publicly stated that China could one day become a bigger market than the United States. This confidence had solid foundations: rapid urbanization, a growing middle class, and Chinese consumers' enthusiasm for Western brands. In those days, walking into a Starbucks for a latte wasn't just about the coffee itself, it was a symbol of status and taste. But that very same year, a startup called Luckin Coffee quietly entered the scene. Unlike Starbucks' emphasis on the third-place experience, Luckin chose a completely different path from day one: small stores, low prices, and quick pickup. By the end of 2018, Luckin had 1,300 stores, about half of what Starbucks had in China at the time. More importantly, Luckin had serious capital backing and an aggressive cash-burning strategy. This differentiated strategy actually reflected two completely different market insights. Starbucks was betting that Chinese consumers would gradually embrace Western coffee culture and consumption habits, while Luckin was betting that the Chinese market had unique demand characteristics: an extreme pursuit of convenience, high price sensitivity, and deep dependence on digital experiences. Few people realized at the time that this seemingly David versus Goliath competition had already planted the seeds of disruption. Luckin's rapid expansion model and tech-driven operational philosophy were quietly changing the rules of China's coffee market game. But this challenger still needed to survive a life-or-death test before it could truly shake Starbucks' dominance. "2020 was destined to be the turning point in this coffee war. Just when Luckin seemed poised to challenge Starbucks' throne, an accounting fraud scandal completely changed the game. In April 2020, Luckin admitted to inflating about $310 million in sales revenue, was subsequently delisted from NASDAQ, and fired its COO and other executives. This event shocked the entire business world, and many thought this coffee rising star was finished. At the same time, the COVID-19 pandemic brought unprecedented challenges to Starbucks. China's strict zero-COVID policies put Starbucks' prized in-store experience model in serious trouble. Although the company achieved explosive growth in the post-pandemic period, it didn't last long. From 2021 to 2024, Starbucks' revenue in China dropped by about $700 million, despite adding 2,200 stores during the same period. However, just when everyone thought Luckin was out of the game, an amazing comeback was underway. In 2022, Luckin emerged from bankruptcy and began an even more aggressive expansion strategy. From 2022 to 2024, Luckin's store count more than doubled, reaching about 26,000 stores today, nearly 18,000 more than Starbucks has in China. Behind this reversal were two business models showing completely different resilience under pandemic impact. Starbucks' third-place concept became a disadvantage under social distancing restrictions, while Luckin's delivery and quick pickup model was actually better suited to new consumption habits. More importantly, the pandemic accelerated the digital transformation of Chinese consumer behavior, which was exactly the area Luckin had been deeply invested in from the beginning. Luckin adopted a purely digital ordering model, where customers could only order through mobile apps. This cashierless experience actually became an advantage during the pandemic. At the same time, Luckin began implementing franchise models on a large scale, allowing it to expand rapidly at lower costs, while all of Starbucks' stores in China remained company-operated. The pandemic didn't just change consumption habits. More importantly, it exposed structural problems with the Starbucks model in the Chinese market. As Chinese consumers became increasingly accustomed to fast-paced, high-efficiency lifestyles, Starbucks' slow coffee culture began to feel out of place. This set the stage for even more intense competition ahead. 2023 marked the entry of this coffee war into its most intense phase. If previous competition was mainly about business model differences, it had now evolved into an all-out battle over pricing power and localization strategies. Luckin's biggest weapon has always been price. In China, Luckin's drinks cost about 30% less than Starbucks, and they frequently offer steep discounts. During early price wars, Luckin's per-cup coffee prices dropped as low as $1.40. This extreme value proposition was incredibly powerful in an environment of slowing economic growth. China's youth unemployment rate remained stubbornly high, and consumer concerns about job security led many to favor saving over spending. In this context, discretionary purchases like coffee were the first to get cut. Starbucks, once a luxury brand, suddenly found itself in an extremely awkward position. Wanting to maintain its premium positioning, but consumers were no longer willing to pay for it. Even more devastating was Luckin's agility in product innovation and localization that far exceeded Starbucks. Luckin frequently launched various exotic flavors, blurring the line between coffee and bubble tea. While this bold innovation made coffee purists scoff, it was deeply loved by young consumers. From coconut cloud lattes to raw cheese lattes, Luckin had new products almost every month, maintaining extremely high buzz. At the same time, a deeper cultural factor began to play a role. As US-China political relations became tense, a "Buy Chinese, avoid American" sentiment grew among Chinese consumers. While this influence was subtle, it was definitely affecting consumer choices. When choosing which coffee shop to visit for a date, picking the domestic brand Luckin over the American brand Starbucks gradually took on patriotic overtones. Facing these comprehensive challenges, Starbucks also began adjusting its strategy. In the summer of 2025, Starbucks announced it would lower prices on dozens of drinks in China, with an average reduction of about 70 cents. For a brand that had always insisted on premium positioning, this was undoubtedly a major strategic shift. But whether this reactive price adjustment could win back lost market share remained an open question. What worried Starbucks management even more was that their average sales per store in China had fallen by half since 2018. This meant that even as store count grew, individual store profitability was rapidly declining. If this trend continued, it would seriously impact Starbucks' overall profitability. In this localization battle, Luckin seemed to have found a business formula better suited to the Chinese market. But Starbucks wasn't giving up. It was brewing a major decision that could change the entire game. In the summer of 2025, news that shocked the business world broke. Starbucks was seriously considering selling partial stakes in its China business, valued at up to $10 billion, with bids already submitted by over 20 investors. Behind this decision was Starbucks' fundamental rethinking of its China market strategy. The potential transaction structure was quite clever. Starbucks might retain a 30% stake, with the remaining 70% distributed among multiple buyers, each holding less than 30%. This design would allow Starbucks to gain much-needed cash and localization resources while maintaining brand control. Bidding institutions included Centurium Capital, the major shareholder of Luckin Coffee, Hill House Capital, and US private equity firms Carlyle Group and KKR. The reference case for this strategic shift was McDonald's. McDonald's had sold 52% controlling interest in its China and Hong Kong operations to CITIC Capital and a 28% stake to Carlyle, while retaining 20%. Later, McDonald's bought back Carlyle's 28% share in 2023, bringing its stake to 48%, with the entire business valued at $6 billion. But Starbucks faced more complex challenges than McDonald's did back then. Meanwhile, Luckin was conducting an even bolder globalization experiment. On June 30, 2025, Luckin opened its first 2 US stores in New York, located in Midtown Manhattan and near Washington Square. This wasn't just simple international expansion, it was a direct challenge to the American coffee market. Luckin numbered these US stores as 00001 and 00002, hinting at much larger expansion ambitions. This numbering system reflected Luckin management's long-term planning for the US market. Reports suggest Luckin plans to prioritize opening stores in cities with high concentrations of Chinese students and tourists, like New York. Luckin's strategy in the US remained its successful formula from China. Small stores, purely digital ordering, price advantages, and TikTok-style drinks targeting Gen Z consumers. While the price gap between Luckin and Starbucks would be smaller in the US market than in China, its convenience and digital experience still offered competitive advantages. From a financial performance standpoint, Luckin certainly had the confidence for global expansion. In Q2 2025, Luckin achieved 47% revenue growth, reaching 12.4 billion RMB, with monthly active users hitting a record 91.7 million. Same-store sales growth dramatically improved from -20.9% in the same quarter last year to 13.4%, showing strong operational recovery. The ultimate direction of this competition could redefine the global coffee market landscape. Starbucks chose to address challenges by bringing in local partners, while Luckin chose to go on the offensive, bringing the battle to their opponent. Starbucks' $10 billion equity sale and Luckin's US expansion are unfolding simultaneously. One is choosing to bring in local partners to defend existing territory, while the other is directly entering enemy territory, seeking breakthroughs. The final outcome of this 8-year business war will not only determine the future landscape of China's coffee market, but could also redefine the competitive logic of the global coffee industry. Regardless of who ultimately wins, this coffee story that began at Beijing's China World Trade Center has already completely rewritten our understanding of market disruption and business innovation.